Stocks are climbing this morning following a tamer than expected inflation report, with blue chips and small caps both outperforming on the day. Groups like energy, financials, communication services all doing well. Joining us here at Post 9, JPM Asset Management's chief market strategist for the Americas, Gabriela Santos. So we are seeing this bit. It's less about big tech for a change and more about everybody else. What do you think is driving that?
So I think in terms of the inflation report this morning, you continue to see a very gradual pass-through of higher tariffs. It continues to be very, very localized on goods that have a higher import share. So to that extent, it hasn't rocked the boat in terms of the macro narrative or the Fed rate cuts that are now already priced in for September. In terms of the market, I do think it's interesting to see what's lagging today, which has lagged a lot this year, which is consumer staples. Because if you think about it, less pass-through showing up in inflation actually means more pressure on margins, right, for companies that have a high import share of their supplies. And here, consumer staples comes to mind, given especially how tight their margins are already. Also, consumer discretionary. So I also find it surprising that today you're also seeing a recovery in small caps together with large caps. To us, that doesn't quite make sense. There, we wouldn't lean into this. We would focus much more on large cap as well as areas of the market that are tied to a good enough economy with gradual rate cuts, and financials for us is the main sector.
Also, we're seeing, some of the supermarket players and the tobacco players get hit because that's actually it's on deflation in those categories. So that's not exactly great for them either. I wonder how much scope there is for disappointment in September. And the market's really setting up now for a rate cut September 17th. I mean, Steve just brought us Schmidt. He's a voter. He didn't sound like he was ready to cut. Do you think that it's a lock as the market is betting?
So I do think really the July jobs report really gave the rest of the committee a lot of cover to get persuaded and ultimately to vote for a resumption of rate cuts in September, just as risk management, just in case the labor market cools further and the unemployment rate rises further. Not our expectation, but I think it gave the committee cover. Now, what I think the market does, it takes it and runs with it, right? So they're increasing pricing in of 50 basis point cuts already in September, which, okay, the probability is not zero, so it makes sense to price some in, but we wouldn't go that far as to say 50 is what's on the table. And I think for equities, that's actually a good thing. You would need a much, much softer August jobs report in order to actually see a rate cut of that magnitude.
Yeah, I was going to say, you don't think a 50 would be market positive for sentiment?
For equities specifically, no, we don't. And I think, there's this narrative that rate-sensitive stocks would do well in that environment, but I think it's really a combination of rate cuts plus a reaccelerating economy, which is not what we're discussing. We would be discussing more rate cuts with a further cooling in the economy. So we don't see that as positive for rate-sensitive sectors, small caps being the prime example, or very cyclical sectors of the market.
Okay, Gabriela, thank you.